You may have noticed that I'm wearing the same hat that I wore on Friday's video. No, this is not going to be a thing. I'm not going to wear this hat every day, but it's particularly fitting that I wear this hat today. Why would I wear it today after I just said it's not going to be a thing and after I just wore it in the last video? Well, for the first time in a long time, since the beginning of the coronavirus pandemic, we had a Fed member use the term not transitory. We've been hearing the Fed members speak regularly, many of which talk about how inflation would be transitory, they had tools to control it, yada, yada, yada. However, today, and I don't want to go too deep into these kinds of things, not trying to start, a culture war here, but trying to remind everyone that the Fed, this entire period, has used signs and signals and subliminals, things from the way they bring up the taper, talking about the taper, etc., to point us in the right direction. I have a conspiracy theory that the Fed chairs who sold stock before the taper announcement was an indication that a taper announcement may come. And we're going to get to that in a minute or two. But today, we had the first Fed chair use the term not transitory, that inflation would not be transitory. Fed Chair Bostic. Now, we've seen a lot of Fed chairs speak and say various things that have had meaningful impact. There's no question this has meaningful impact, and it's quite a big statement. At the same time, we've only seen Fed chairs who are white males speak. We've seen the Fed take on racial goals, as Powell has said. And today, we heard this not transitory statement come from Bostic, who is a black man. We've not heard any major statements. As far as I'm aware, I may stand corrected. Please feel free to correct me in the comments. But black men say these comments. This is quite interesting when you start to look at why and consider why that might be the case. It's no surprise to anyone that black people happen to be very economically sensitive. People often complain about how black people are disproportionately represented in lower income groups. And unfortunately, who does lower income groups impact the most? That's right, or inflation, not lower income groups. Who does inflation impact the most? That's right, that's lower income groups. So I'm not saying this is for sure, but it seems like a pretty profound statement from the right person on not transitory. Hence, that again. All right? Last Thursday night, actually, we made it the Twitter profile picture, and the YouTube profile picture. So, it's transitory, sarcasm, it's freaking not transitory. So we're seeing now. Now, what does this mean for the rest of the market? Well, we don't like to talk about the market in aggregate here. We like to talk about what is a good investment at the time. We consider the market, we occasionally get into that. We've talked about broad market things in the past, and we've made some broad market predictions. Recently, we've only talked about specific plays, but broader market, we've obviously seen a pullback here. And it's kind of hard to tell what exactly the next step is going to be. I was reading information out of Fundstrat today that said we're right on the edge of a knife's edge, being the 100-day moving average. It appears that we have pushed past that level, and that could indicate further selling. And I think there's a good chance this happens. I'm not saying it's guaranteed. I'm staying away from the broad market because it's been a surprising market. that we've had. I'm sticking to plays I think can win regardless of where the market goes. However, there's certainly things that seem to occur, and they might not seem 100% clear, but they seem to occur and likely will occur going forward. One of which is rising bond yields. Yes, today is strange. It seems almost impossible to have days like this when the market goes down and bond yields go down and have a prolonged sell-off, because at some point bond yields are going to fall to a rate and people are going to transition to the stocks that present a better risk-reward premium because the reward is so low on bond yields. Today, stocks were down and bonds were down. So people are flying to safety, but how long can they fly to safety? If bond yields rising impacts the market, but the market is going down and bond yields are going down, then rising bond yields won't impact the market because they're going down. Well, I think that the market going down can be regardless of the short-term flight to safety move in bond yields. That's because bond yields have fundamental impacts on them that won't let them have a 100% correlation to stock market down, bond yields down. One of those forces is inflation. Inflation is now not transitory. That is profound. If inflation is not transitory, bond yields can't be at 1.5% on the 10-year and 2% on the 30-year. Inflation is going to be higher than 2%. That is what's considered inflation, apparently higher than the average rate of inflation. And right now it's about 4, 5, 6 and higher percent. It's going to be high. And who's going to take 4, 5, 6 or 1.5% when the value of that money that they're getting back is going down 4, 5, 6% every year, right? That's a little dumb, if you ask me. But I've been saying that for a while, as is lots of people. It's no surprise that buying bonds in this environment is dumb. Dumb. We don't like to use that word. We're not trying to be mean to anyone. We're just trying to be as correct. And, I'm not going to say objective because these are opinions. It's not, something being dumb is not objective. But we're trying to get the greatest rate of return. And it seems bonds are dumb when it comes to getting the greatest rate of return. So I think even if the market falls, bonds can't remain at these low levels with inflation. In addition, bond yields go down when people buy. When there's a flight to safety, people buy bonds and rates fall. The largest participant in this bond purchasing market of U.S. Treasuries is the Federal Reserve. However, the Fed, despite this non-transitory statement, etc., is going to taper, and taper now, soon. So you are removing the largest purchaser in this market, and they're not going to go away tomorrow. They're going to start decreasing their purchases, but by billions of dollars, relatively rapidly, over the course of months. And this is a market that is already trading at lower than historic volume. So that is concerning for the bond market, quite concerning, and could lead to ultimately rising interest rates regardless of what the market does. So that is scary. We'll have to see what happens with that, because I don't want to get into things here, but if that's the case, we're in a multi-year possible bear market for bonds, implying that multiple years consecutively bonds should rise, bond yields should rise. We've also got inflation that is apparently correlated with tech stocks declining, even though I think inflation is lift all boats. But bond yields rising is something you can't fight. This is something Warren Buffett talks about, and we're not going to fight the bond yields. Now, Not saying the Great Depression is going to occur. But if the bond yield situation gets extreme, it will occur. Possibly. I don't know. Possibly. I don't want to get too extreme about that because the situation is very uncertain with regards to the broader market. That's why we're not playing the broader market. So what are we doing to win in this environment? Because we feel good about the portfolio. We are all in. But how can we be all in if we're concerned about rising bond yields? We feel pretty good about that. And they impact the market negatively. I have no short positions right now. What am I doing and how am I prepared? Well, inflation is a big force, and we can participate in areas of the market that will benefit from inflation and avoid areas of the market that will be hurt by inflation. One of the areas that will be benefiting from inflation, and no, we're going to get into energy in a sec because it is, but we're going to bring up something new that we brought up at the end of last year and beginning of this year, are mining and material stocks. To mention two names, I have recently taken quite large positions after the unwarranted sell-off, I think. Quite large positions of companies BHP and GOLD, Barrick Gold. Why am I taking these? Well, BHP is foreign, Australian-based company, however, has a wide array of quite crucial metals, many of which are used in electric vehicles and seem to have pretty consistent demand. Yes, they might be impacted by economics. If we see an economic slowdown, that may certainly impact them. However, prices of these products should adjust with inflation, and we've certainly seen this. Yes, some are well off the highs, but they have stabilized, and there's no saying that they're going to not go up again. We'll see. The stocks are down big, 10% yield, 11% trailing multiple. That's quite attractive. Barrick Gold, we all know gold. We all know copper, which is up quite significantly. Gold has had a bit of a pullback. However, if we get into a concerning environment, we should expect gold to rally. Now, obviously, rising bond yields will impact gold, but it is a very expensive product that will do well in inflation. And it remains to be seen. Yes, bond yields will go up, but will real yields go up? That is another question that must be begged. I believe if real yields stay the same, meaning that we have inflation increasing the change in the nominal yield, we may see gold perform quite well. So we're keeping GOLD in the portfolio well off the 52-week highs. Mining stocks. We like them if they're good, with a good multiple and not too much debt. Ideally, with a dividend. BHP's is massive. Gold's is not as big, but we know and love and trust those products. Energy. We all know about energy inflation, as long as you don't have a Tesla. But even if you have a Tesla, you're probably still maybe feeling it at the electric charger. I don't know. I don't have one. But certainly, if your house uses propane to heat, woo, you're feeling it. If you're living somewhere where you're not having to use the AC yet, it's gonna get worse in the winter. Just you wait. So, energy stocks are obviously a favorite of this channel. However, they benefit from something we've been talking about as hurting stocks so far in this video, and that's rising bond yields. Why is that? Well, if you're familiar with the idea of discounted cash flow, the concept of $1 today versus $1 in the future, energy stocks benefit because they present dollars today versus a bond, which is a long-term asset and presents dollars in the future. That's why bonds will impact tech stocks and growth stocks that present future dollars, but not the energy stocks, which are making a whole lot of money right now. More than usual. High dividends, many engaging in stock buybacks and dividend increases, and they have all said, for the most part, that they aren't investing capital back into new growth, back into new energy production. They are returning capital to you, the shareholder. So we want that cash in our pockets. Energy stocks is the place to get it. and they will adjust with inflation. The key thing we want, the hat, the beneficiary. We don't need to worry about what's going on in the market over here. If we got energy stocks, in my opinion, we should be feeling good. That is what I like most. Again, I have said that rising bond yields will impact tech stocks. However, I have a discrepancy and an asterisk next to that. So the market broadly, commentators, etc., call growth stocks like Amazon, Apple, Microsoft, you know, the FANG group. I do not use the term growth stocks, if I don't have to refer to these stocks. In my opinion, a growth stock is a stock that has the ability to 10x or more. It's unlikely we see Microsoft 2x, let alone 10x. So, is that growth? Are we giving that kind of 10-20% growth per year the title growth? Or are we giving that to some tech startup? In my opinion, that term should be reserved for the tech startup. And that's what we're doing here. So I happen to still like these very cheap, very well priced growth companies that have the potential to grow at some rate significantly higher than inflation and be part of this lift all boats event that should occur with inflation. Now, Amazon, Microsoft you need to wait 30, 40 plus years to get your money back. I don't know. Back to the discounted cash flow thing. We prefer energy to that. But something that's growing at 50% per year with inflation around 5%, maybe a little higher, maybe a little lower, that should be safe. So, mining, energy, big time growth stocks, well priced. That mix, bang. Eight strong together, boys. What to avoid? We've already talked about it. The super expensive, high multiple, you gotta wait many years to get your money back stocks. Not for us. I was short Apple, Microsoft, closed both those shorts for a gain recently. However, I'm afraid to touch it. So that's the deal. And until next time, peace out.